What's up, everybody? Nate here. So all eyes have been on the Federal Reserve for pretty much the last 6 months, mainly because of the trillions of dollars they've pumped into the US economy and the stock market, and also the massive changes they've been making to their interest rates and monetary programs in the United States. Oh, and not to mention that little thing called inflation hitting another record high in January 2022. Yeah, that's pretty much all the Fed. But lately, a little bit of the pressure and eyes have been taken off of the Federal Reserve because of the Russia-Ukraine crisis. That's been occupying a good portion of the news over the past couple of months, and it's a little bit of a convenient escape for the Federal Reserve in terms of why inflation is getting so bad right now. With all that being said, the Federal Reserve still has a massive decision to make when it comes to how it's going to lower inflation in 2022. And while it has a lot of ideas on how it's going to tackle inflation this year, ultimately none of them may end up becoming true because the Federal Reserve and its inflation decision is getting more complicated by the day. So just like what we saw in 2021, the Federal Reserve may flip its narrative in 2022 on inflation and what it's going to do about it. And they may need to change course completely in order to not cause our economy from taking any more damage, which is gonna have some consequences. So today I want to talk all about the Federal Reserve and their complicated monetary policy and inflation decision that they're going to need to make in 2022. I want to talk about why the Federal Reserve may completely change course on inflation and its stimulus in 2022, and why changing things up might not be enough to save our economy this year. But before I break all of this down, do me a quick favor and hit, smash, or destroy that thumbs up button below, and ring that notification bell too. Both of those two things are completely free, and they help to show me that you like this video and that you want to see even more just like it. Thank you so much for doing that, and now let's talk all about what is going on with the Federal Reserve right now. So the Federal Reserve's monetary policy decisions are looking a bit muddy. Over the past couple months, the Federal Reserve has talked about getting super aggressive when it comes to inflation. Now they want to lower it because every single month, inflation has consistently set new record highs. In fact, in January 2022, inflation hit a new 40-year high of around 7.5%. And considering the Federal Reserve is kind of the chief agency of the United States to manage inflation, it's kind of doing a bad job. Inflation threatens all different parts of our economy all at once. Not only does it mean that the value of our money is starting to decrease, it also means that the price of just about everything is going way up. And considering around 70 to 80% of our economy is driven by consumer spending, if consumers stop spending, well, then that's bad news. So what has the Federal Reserve talked about doing? Well, one thing they want to do is raise their benchmark interest rates up from around 0%. You see, when the pandemic started all the way back in March of 2020, the Federal Reserve decided to lower its benchmark interest rates all the way down to 0. And the reason they wanted to do this is to increase demand for spending in our economy. They wanted it to be super easy for just about anyone to get money and spend money. So it was super easy for people to get a mortgage loan or an auto loan and even spend on a credit card because the interest rate was so low. Obviously, that caused a lot of problems, and then couple that with supply chain issues caused by economic lockdowns, and you pretty much have inflation surging faster than we've ever seen. So like I said, they want to raise their benchmark interest rates to take out that demand from our economy. They put demand into this world, and they can take it out too if they want to, and they've talked about doing that in March of 2022. Now this is where things start to get a little bit complicated because we don't exactly know yet how much or exactly when the Federal Reserve is going to raise its benchmark interest rates. Some Fed presidents have come out and said the Federal Reserve is going to raise rates around 3 to 5 times in 2022. The stock market believes that the Fed is going to raise rates 5 to 7 times this year. And most experts are saying now that a 50 basis point hike is coming in March of 2022, and we could have multiple hikes like that this year. Now that's all well and good for inflation. That's definitely going to bring down inflation because it's going to be way harder for people to get a loan or spend money in general. Remember what I said before about mortgages and auto loans? Well, it's been easy to get those because rates are near record lows. If they start going back to normal levels, then people aren't going to be able to afford those mortgages anymore. Especially since we have such high demand for everything right now, it's going to be super hard for anybody to get anything, which means demand is immediately going to exit your economy. Now that doesn't sound complicated if that's all you talk about and that's all you look at, but there is a lot more going on in our economy and the world economy right now. We have a Russia-Ukraine situation that is completely boiling over. In fact, as of February 22nd, 2022, Russia has actually sent troops into Ukraine. Now you might be thinking that is a geopolitical issue and it shouldn't really affect the business and financial world all that much, but the fact of the matter is it actually affects it a ton. And the reason being is because Russia is a big producer of a lot of the things that the United States uses on a day-to-day basis. We're talking natural gas, oil, wheat, and a ton of other metals. Russia is the #1 producer of all of those different things. Now that's cool for Russia if the United States and the rest of the world is cool with Russia. But by mid-February, because of the actions Russia has taken against Ukraine, the UK and the United States have started imposing economic sanctions on the country. And what that means is it's going to be a lot harder for Russia to get a lot of its goods and services into that country. Not only that, but it's going to cost them a lot more. So we're not completely cutting them off, we're just making them pay more. Obviously, Russia is not going to like that. So they're most likely going to start imposing sanctions on the United States, UK, and the rest of the NATO nations. Which means all of those things I listed before about Russia being the #1 producer in, well, it's going to be harder for the United States to get those things. And even if they can get it, it's gonna cost them more. So now we run into the first problem for the Federal Reserve. Inflation is going to start going up rapidly for energy and metals and the wheat industry in our country. The biggest concern here is over oil and the price of oil going dramatically higher in 2022. Oil right now per barrel is priced at around $92 to $94, which is still way higher than it was over the past couple of years, but it could go even higher if we see Russia completely invade Ukraine. Oil could go up to around $120 to $150 a barrel in the coming weeks, would essentially mean that the price of gas for most US consumers is going to go up between 30 and 60 cents. That is a massive increase on a good that most Americans use just about every single day. And ultimately that is going to cut into American spending, which means they're not going to have a lot of money for other things in our economy. What the Federal Reserve needs to look at here is how that is going to affect consumer spending in the long term, because if the Federal Reserve continues to restrict our economy via its interest rates and inflation still goes up because of the Russia-Ukraine situation, well, then it's going to kind of be double trouble for our country. And the Federal Reserve is also most likely going to look at how long this Russia-Ukraine conflict could last for, because as most investors and experts know, geopolitical conflicts like this, while they can have a massive effect on markets, interest rates, and our economy, are oftentimes short-lived, meaning they don't last forever, which means the effects that they're going to have on our economy and world are not going to last forever either. But the effects of inflation will last much longer than a conflict in Ukraine and Russia, simply because the definition of inflation is when your monetary supply starts to increase. The central bank of the United States, which is the Federal Reserve, starts printing a lot more money, which means there's way more money in circulation within your country. Now that in itself is not a big problem because in essence you just have a big stack of cash somewhere. However, the problems start coming in when people spend that money. When you're giving your population thousands of additional dollars for an extended period of time, well, that is a big problem because now they have way more money than they used to, and the majority of Americans are going to go out and spend that money or invest that money. This is part of the reason why we've seen inflation go up and the price of assets go up too. The majority of Americans have been throwing money at pretty much whatever they wanted to over the last 2 years. But now the Federal Reserve wants the inverse to happen. They want to raise interest rates and take that demand away. But as all this money has been pumped into the economy, well, Americans have been able to buy more, which means the price of everything needs to go up because businesses and companies have to produce more. They can't continue to produce all of the same things because demand is way higher for all things. So companies have to make more, and in order to do that, they have to take on a certain amount of costs. Labor costs, like hiring new workers and paying their continuing workers more money. In addition, they have to build more factories so they can create more goods, and so on. But when those businesses take on more costs, they eventually trickle all of those new costs down to the consumer. So all of the things that the consumers were buying more of before, well, now they can't afford to buy as much because everything costs more. That system essentially will balance itself out once demand starts to go down, because that signals to businesses that they are making enough. They don't need to make more, they don't need to hire a ton more workers because everything is in equilibrium. But it doesn't really work out that way if we still have inflation going way up. And that's the problem for the Federal Reserve right now. They need to kind of weigh the pros and cons between being as aggressive as they can on inflation and raising their benchmark interest rates, pulling their stimulus, and doing everything else that they can in order to bring it down, or playing the long game and trying to figure out what's going on with the Ukraine-Russia situation, because if they act too strongly now, that could essentially tank our economy. The fact of the matter is, the Federal Reserve has no control over what goes down in Russia, Ukraine. Even if the United States didn't impose economic sanctions on the country, well, Russia is going to be using a lot of its resources in order to help its invasion effort, which means those resources are not going to be going to other countries around the world. The fact is, though, the United States has issued economic sanctions against the country, and we can bet that retaliation in the form of more sanctions from Russia is coming to the US sometime soon. That means the price of everything that Russia exports to the United States is most likely going to go up. Meaning everything the Federal Reserve has talked about doing over the last 2 years, well, it might not be able to do that come this March. You see, if the Federal Reserve gets super aggressive with inflation now and does everything they can to lower it, well, what that's going to do is reduce demand, but demand is already going to start going down because of the Russia-Ukraine crisis. Everything is going to continue to cost more, so raising interest rates in the United States on regular everyday consumers is going to be a problem. The Fed just might make it harder for Americans to spend money again, and remember, that's not going to solve any of our supply chain issues, so businesses and consumers are still going to be hurt there. And in the short term, goods and services that are coming out of Russia and the Ukraine region are probably going to cost more than they have over the last 2 years. But on the flip side, the Federal Reserve can no longer ignore this inflation issue. Most experts and investors agree that the Fed is way behind the curve when it comes to what needs to be done with inflation. If they completely ignore it, well, that means continuing the status quo as is and continuing to print money like there is no tomorrow. Which means in that situation, things are still gonna cost more money because there's so much more money in our economy. The Federal Reserve over the last 2 years has been pumping billions of dollars every single month into the New York Stock Exchange. They wanted to lift markets out of one of the fastest crashes we have ever seen. But in doing so, it's also caused asset prices to hit new record highs. They've basically been funding investors over the last 2 years and allowing them to get super risky with all of their investments. That has led to markets going up significantly because they've been buying corporate bonds and mortgage-backed securities, and government spending has been encouraged to go up too because they've also been purchasing treasury bonds. Record spending and record highs is now leading to record lows in all of those industries, as we're starting to see markets in the United States come way down. All of that spending cannot continue in our economy because the value of our dollars is basically going to deteriorate faster than we've ever seen, meaning everything is going to cost more and more, and our supply chain issues will never get solved because demand never goes down. But the Fed could be making it worse because when they raise their benchmark interest rates, people are going to be restricted in their spending even more. And that could leave Americans with nothing. No extra money for investments and spending, and no extra money to move into a new house or buy a new car, sending our US economy into its next recession, all because the Federal Reserve is getting aggressive on inflation right now. So with all that being said, what exactly can the Federal Reserve do at this point to lower inflation without causing a full-blown recession? Well, short of getting a time machine, not much. All of this money printing and the money they've been pouring into the US economy and the stock market over the last 2 years has helped things go from a ground zero all the way up to record highs. When the pandemic was first starting all the way back in March of 2020, we needed that money because the fact of the matter is Americans did not have the savings and businesses did not have the savings to protect themselves. So the federal government and the Federal Reserve needed to step in at that point and provide stimulus. They couldn't let millions of Americans and businesses fail because that's also bad for our economy. They need people to spend money because that's how our economy grows. And it proved to be super lucrative for the economy because we ended up coming out of one of the quickest recessions we have ever seen in American history. But the issue is how long they actually kept that money printer on for. Now the Federal Reserve has racked up a balance sheet from stock market assets of nearly $9 trillion. And we've printed around $5 trillion on top of that over the last 2 years in various bills and direct stimulus payments to Americans. All of that comes at a cost. And like I said, there's an argument to be made that the United States needed that back in 2020 and in parts of 2021. But we are in 2022 now, and the conversation has to be had, should we have stopped earlier? Well, most experts agree that yeah, the Federal Reserve should have stopped a lot of its stimulus a lot earlier in 2021 to allow the economy to start recovering normally. It hasn't really done that, so now we're going to be facing some pretty serious issues with inflation and a possible recession in 2022. There isn't really much the Federal Reserve can do now because their only option is to restrict spending. They can't go in the opposite direction because inflation is surging faster than ever. So they have no choice but to continue to be aggressive even though there are things that are out of their control like the Russia-Ukraine situation. Their only hope is that a diplomatic solution there is found sooner rather than later. So that way they can make their monetary policies and Russia and Ukraine no longer affects what they're going to do. But if you ask me, I think the Federal Reserve is going to continue to be behind the curve on inflation because at the end of the day, they don't want to be the bad guy. The federal government and the Federal Reserve never wants to be the bad guy when it comes to doing what is right in our economy. They will always do what's easy before what's right. And the reason being is because the Federal Reserve Chairman Jerome Powell and President of the United States Joe Biden are constantly putting their jobs at risk when they make policies. If the Federal Reserve says they're going to tank our economy in order to bring down inflation, well, that's not going to be liked either because that means demand goes down so much that Americans can't buy anything. But if they keep telling United States citizens that everything is going to be okay and they slowly bring down inflation so that way people don't notice, well, then they're not going to look like the bad guys. And consumers will still have the confidence to go out and spend. This is the reason why the Federal Reserve has talked about inflation being transitory for the last 2 years. They changed their narrative at the end of 2021, but for the majority of the last 2 years, they said inflation was transitory. For one, they didn't want to scare the American public and stifle consumer spending, but two, they don't want to be the bad guy. And three, 2023 is an election year. President Joe Biden is going to be up for re-election, and he doesn't want the economy tanking while he's in office. In fact, no president wants that, so they're always going to continue to print money and do what's easy because that's what's going to get them re-elected right now. So yeah, things are probably going to get a lot worse before they get better. And at this point, the Federal Reserve has around 3 weeks to make this decision because, like I said, in March of 2022, that's when things are really going to start happening. So in the meantime, keep an eye on consumer spending and markets around the world. In addition, keep an eye on the Russia-Ukraine situation because if that changes, well, that could have a drastic effect on what the Federal Reserve does in 2022. But now I want to hear from you on this issue. What do you think about the Federal Reserve's new complicated decision when it comes to inflation in 2022? Do you think they'll do what's hard and actually get super aggressive on inflation no matter what? Or do you think the Federal Reserve is going to take the easy route and slowly bring back their economic stimulus and slowly raise their interest rates in order to avoid being the bad guy? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching, If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if video is more your thing, I'm putting out updates 7 days a week over here on this channel, and I've actually got one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.